Hello, ladies and gentlemen. My name is Greg Michalowski for ForexLive.com. This is a Euro versus US dollar preview for the week starting November 10th. I'm going to title it ECB Dovish, US employment solid, Euro dollar lower. Let's start off by taking a look at the ECB and what happened with them this week. We had their interest rate statement and also the press conference by ECB's Draghi. There are three main themes that I took from the ECB press conference. One, that the ECB officials were unanimous on more stimulus if needed. Two, Draghi sees and the ECB sees downward revisions to their forecast, so for forecast for growth and inflation. Is that the if needed that they'll need for additional stimulus? Time will tell. Three, ECB assets to expand. And so it almost seems like a fait accompli that that there's going to be more stimulus, that there's assets that are going to expand, that the balance sheet is going to get larger, that there's going to be downward revisions to forecast, and that the officials are unanimous that they'd have to add more stimulus if needed. It almost seems like it's needed. So that's what I took from the ECB. That should be euro dollar bearish, with the euro moving to the downside, dollar getting stronger against that currency pair. Now let's fast forward to the employment situation out of the US. And what did that tell us this week and this month? We saw the non-farm payroll rise by 214,000. That was less than the 235 expected, but there is revisions to the prior month of 31,000. So if you add the 31 to the 214, you get about 245, higher than the expectations of 235. Solid employment report. We saw manufacturing payrolls rise by 15,000. Unemployment rate come down to 5.8 from 5.9, which is the lowest lowest level in this move to the downside. We saw the unemployment rate also move to its lowest level in the downward momentum that we've seen since the peak. That came in at 11.5 versus 11.8. We saw the participation rate stay fairly steady at the lows at 62.8 versus 62.7. The market seems to be a little bit more immune to that statistic. But we saw the wages disappoint, only a 0.1% gain and 2% year on year. The market is looking for higher wage inflation, more money in the consumers' pockets, just not coming into their pockets, which is one of the concerns about the employment report. But overall, a solid employment report. Again, more bearish for the euro, more bullish for the dollar relative on a currency basis. I would expect that trend to, from a fundamental standpoint, to speak to a lower euro. Now let's take a look at the euro from a technical perspective. And what are we seeing here as we end the week? Well, we're seeing the market actually rally to the upside and squeezing in the New York afternoon session. London's gone, mind you, so this could be just late week trading that's taking place. We're seeing the market move up to the underside of the broken trend line right here. We'll also see the 100-hour moving average come into play right here. And this area right here, where the 100-hour moving average and the broken trend line is going to be a key line in the sand for trading next week. Move above it, that would be more bullish. Move below it, that would be more bearish. And you say, Greg, you're bearish, but I listen to the technicals first. The fundamentals, they tell me a story, but the technicals tell me what the market is thinking. So if the price moves above the 100-bar moving average and the trend line right here, or the 100-hour moving average, that would be more bullish. The next target on the top side would be the 124.99 level, and that level corresponds with this low going back to early October. Trend move to the downside, bottom, biggest correction to the upside in the October month, and then the market moved down and through that level in trading this week. As a matter of fact, here is that 124.99 level, and on Wednesday or Thursday when the ECB decision came out, kind of went through that level like butter, moving to the downside there. So that will be another resistance area. And then this top side trend line, this would be another big line in the sand here. Why? Because we have 1, 2, 3 levels along that trend line, and that line when you get three points on a trend line becomes more important for traders, and so this level is going to be of interest. Comes in currently around the 125.16 level, but it'll be moving lower, may even get down toward close to that 125 level maybe on Monday's trade. We should have both of those levels coming together. So that's going to be a key level for a key line in the sand as well for traders in next week. Again, if we move above that level, that would be more bullish, and we move toward the 200-hour moving average. So really, the bullish bias bullish bearish bias turns more to the upside right here. As long as it stays above, it's more bullish. If we stay below, it's more bearish. Now, where do we go on the downside? And we only have, this is our low for the year. This is our lowest level going back, as a matter of fact, to 2010, 2013, or I'm sorry, 2012, 2013 lows are up here. So the market off the hourly chart needs to get to and through the low for this week at 123.57. Then we open up the door for further downside. What are the other levels on the downside? I have to go to the monthly chart here to show you where I honestly think the euro it would be moving toward, as long as we can remain below those levels that I outlined on the top side. So as long as the bias is to the downside, I see a continuation of the trend lower for the euro, and would not be surprised. My key target level would probably be around the 50% retracement of the move up from the all-time low for the euro down here in the year 2000 to the high that we saw in 2008. That 50% retracement comes in at 121.31, and I wouldn't be surprised if the market ends up heading down toward that way before now and the end of the year, next couple months of trading. That would not be out of the question in my mind. Other levels of importance here are 120.40, which is a 2012 low. Then we have the 2010 low, which comes in at 118.76, and the 17.43 level. What's the significance of that? Well, if you go back to January of 1999, that's where the euro versus US dollar was introduced to the market at 117.43, and from that point, right here, the market went straight to the downside to its low level at 82.25, which was reached in the year 2000, October of 2000. From there, we rallied to the upside, and it was in November of 2003 that the market moved back above that 17.43 level. It was only 2 months that the market traded below the 17.43 level since 2003. That was these 2 months right here, and each of the months no close below the 17.43. So it's good. You have to go all the way back to 2003 before the last time that the euro traded below its introductory level. Are we heading down that way at some point down the road for the euro versus US dollar? I wouldn't say it's out of the question, but we got to keep that bearish bias. And again, I'll repeat, as long as the price remains below this area right here, the bias remains to the downside, and we can go lower. If it moves above that level, turn a little bit more bullish, but as long as we stay below that level and keep some of the bearish momentum, we could see this price start to move and continue to trend to the downside toward our support levels outlined off of this monthly chart. My name is Greg Michalowski. Good fortune with your trading. Bye-bye now.